We've got Sreesankar also joining us this morning. Sri, good to have you with us. We've got a couple of divergent views on market outlook. Amit starting to turn a bit optimistic. Rahul still a little wary. Where do you stand? What's the next move according to you?
Our own recommendation has been that probably the market should be in a trading range between 72 to 7,800. I think the market had gone above the trading range. So my view was that I was not very optimistic. Global factors will continue to drive it, and for the market to break out of this particular range, we need to see a steep increase in earnings. On the contrary, with what has happened with Axis Bank earnings and the kind of caution that they have put across, etc., probably I think the banking earnings growth, which in our estimates would have been closer to 28% for the Nifty, and would come down. So if it comes down, it will bring in the total earnings growth for the entire Nifty for FY17, because banking still has closer to 28% weightage in the entire in Nifty. So here we have a question of what's the kind of a growth estimates you have for the Nifty for FY17, at the moment, with all the results that is out, whichever results which has been out, it doesn't give me any confidence saying that you're going to see the market moving up to crossing 8,000 or 8,000, reaching 8,500 in the near term. So I will still remain cautious. We still think that it's going to be in a trading range, and that trading range, as mentioned in our April report, was around 7,200 to 7,800.
Morning, Sri. Just getting away from the levels on the index. For the last few days, I've just been wondering. Here are Indian companies that have to compete with Japanese companies that basically get money for free, and an Indian company ends up paying an opportunity cost of 15 to 16% on an average after you take all the costs of getting a loan, and yet they survive, and yet they report such nice earnings. Do you think with a lag time, let's say 6 months to 12 months, many of these companies could really be reporting, way better numbers as the economy improves? Just keeping the index on the side, and if that is going to happen, where do you think, or what part of the sectoral part of the economy do you think it will come from?
Okay, actually, that's a very interesting question. Let me just rewind this a bit backwards. I think in the economic survey there was a mention that the industrial capacity utilization of the industries is around 70%, down from 73% in FY15. So that's a barometer, that's a benchmark. Now, when you mention about economic growth plus that earnings growth kicking in, first what we are saying is that you have to see an economic growth increase or capacity utilization increase, which should start to see happening in that industry. So once that will be reflected in the industrial growth going forward. Now, once those numbers start to happen, obviously the earnings growth estimates has to get revised upwards. When will that happen? I think we are banking on today. Let's look at even every one of those agrochemical companies, Rallis, Bayer, PI, Sharda Cropchem, you name it, UPL, name it. All these stocks have actually moved up in anticipation of a good monsoon. But does the commentary so far give you any confidence that the earnings growth are going to be very strong? I don't think so. But from whichever results have come. So now markets have already discounted to a certain extent the price, or as someone was earlier mentioning, the PE has already gone up. E has not yet followed. Earnings has not yet followed. That's number one. Number two, we anticipate that kind of spending that the government is doing in infrastructure, rural, railways, and all these things should start to see in earnings happening, and also as consumption improvement. I think it will only happen in 1Q, towards the end of 1Q, once that 7th Pay Commission actually pays out certain things, and also ORP. So I think the effect will come only by around second half. So market, once it starts to happen, will slowly start to see the market may discount by around June, July, but real effect in terms of corporate earnings, I don't see it happening before probably September. And once that happens, then we need to revisit everything a second time. Hopefully by then the kind of problems that is there in the global economy side also is somewhat settled.
Let me come back to you. You know, we've got some amount of action coming in on some of those commodity names once again, and the reason I just come back to that is because it seems to be a rally that's possibly built up, you know, by a bit of momentum, a bit of trading action. Which is, do you feel, you know, that it is looking volatile from a fundamental point of view? I mean, if someone did go in and invest in these stocks, looking at the kind of buzz of late, would it still be a good time to get out?
See, I'm a bit cautious on the commodity stocks. Why am I cautious? And in fact, when we look into the factors why we were away from commodity stocks, for better part of last 12 months, commodity stocks have given only pain to investors. Last 2 months have seen a very sharp recovery in commodities. Where you name it, you have seen it in every one of those commodities. Quite sharp, industrial as well as agricultural, mostly industrial. You've seen these sharp recoveries, and before 2 months back, people were expecting severe slowdown to happen in China. I don't think things have changed on its head so much in the last 1 month in China to wanting it to rally to that extent. That's number one. Except that news reports which keeps coming out to a great extent, it clearly indicates a kind of speculative activity which has been happening in the futures market in many of these commodities, etc. So I'm not willing to believe today that fundamentals have changed for the commodities for the better. That's number one. Number two, the huge amount of speculative activity, especially in the futures, for a lot of industrial commodities have even pushed up these prices. Can it sustain its own on a fundamental basis? Because if the demand doesn't follow, the real demand doesn't follow, this can actually come off. And that's the reason why I'm not overly optimistic, because I can't see the real demand growth happening around. But once the speculative activity gets a sheen out of it, or that bubble goes away, probably you are in for again tougher times. Now, the current environment, everything looks rosy, but fundamentally, I don't think we have actually got a lot of reasoning to believe that this kind of a rally will continue and everything is behind us. Probably one thing is certain, that probably the bottom of the commodities for the near term has happened. That's it.
Let's get your view in on some of these FMCG names as well. Dabur, for example, Shree and Focus, raised to a buy. We've got Marico that we're still watching out for.
Hello, is it to me?
Yep.
Yeah, Dabur continues to be a part of our topics, you know. In fact, we've had Dabur in our topics, and we see no reason why we should change it. We continue to believe that it's got a strong revenue growth of around 14% in both FY17 and FY18, with an earnings growth of around 13 and 14% for both these years. So we continue to have that kind of growth estimates. We don't think that it's going to get severely impacted by the Patanjali onslaught, if I may say so, which has been the biggest concern of the market, and it remains a part of our topic.
Sri, you of course speak to institutional investors, and the general gist of what you've been saying looks like the market's run ahead of underlying economic conditions. Could that then result in some kind of selling from institutional investors, especially of overcrowded trades like banking stocks or you know, the 10, 20 stocks that they all are invested in any case?
I think Ashu, if we again look at the entire way institutional, see, the domestic investors have been seeing inflows, so they have probably seen a sector rotation changes which is happening around. Now, to answer your question on the financials, especially the banking stocks, which they have overowned, if I may say so, or concentrated on, 28% of the index is in banking. So obviously there is a large bearing on the banking stocks by the institutional investors. I think most of them are overweight private sector banks, and very few of them have got exposure to public sector banks. The reason is public sector issues continue to be there. Again, within the private sector banks, you see some banks, you know, HDFC Bank is a bellwether for every one of those investors that you look through in their portfolios, you will find them because the comfortability that is there with it. And the way I look at it is that comfortability is reflected in the high price to book value, that adjusted book value the market is willing to give for HDFC Bank, which is I think 3.5x as we speak for FY18 kind of scenario. So this is something which is there in the market. So when you come down to look at other banks, you find Axis, ICICI at lower multiples in Yes Bank, etc. So in IndusInd, Yes, and everything is at a much lower multiple when compared to HDFC. So that the higher multiple the market is giving actually is telling you about the kind of confidence level that is there. Now you look at public sector banks, it's probably half the book that you are seeing it across. Why? And they don't believe in it. That's what the market is saying. Number one. Number two, will they sell? If the economic growth, as you mentioned, as I mentioned also, we expect to start seeing in the second half. We expected in FY16, it didn't happen. If it's expected now in FY17 with a good monsoon, then actually banking should lead the growth, and a lot of stress that you have seen probably start to unwind itself, and recovery should also start to happen, which means that the bigger kicker in banking will happen along with a good monsoon and an economic recovery. So I don't think that you're going to see a huge selling unless and until something goes wrong quite dramatically globally, and in the domestic side, economy doesn't recover at all. In fact, it goes into a further slowdown, capacity utilization further slows down, and you have further problems in the outstanding credit portfolio, which I don't see happening in the near term. So my short answer to that long one which I gave is, I'm not expecting to see a large amount of selling happening in the financials unless something dramatic happens which will further deteriorate the asset quality.
Maruti is the other one, Sri, that I want to come to you on. Given what we're seeing on the yen, anything to be, would you be worried? I mean, the numbers were good, but the management still did sound out a few challenges going ahead.
I think the key question is on not on the yen alone, it's on the operational factor. The currency is something which you can't put a handle on and say this. But I think the product offering has been good. The products, the new products which is at different price points, at different, be it in terms of SUVs, be it in terms of the smaller cars, and probably Alto is getting serious competition. There are new products which is coming up. There's an offer which is there at every price point and every different segment of the automobiles, especially in the passenger car segment, which I don't think any one of the competitors have today, San Hyundai to a certain extent. So Maruti continues to be strong on the fundamental side. Currency is something which will get a volatility happening around thanks to the volatile yen. And that's not something I think Maruti can handle straight away. Or for that matter, you can't have a 5-year vision for the company based on the monetary policies which keeps happening every now and then. So my thought is fundamentally it's looking good. You have to bear in mind that occasionally you will have the currency impact hitting it in terms of performance. But as long as the numbers keep looking good in terms of volumes, I think I'll still continue to look at Maruti, because Maruti is the best positioned in the automobile passenger four-wheeler segment to do it. It's a part of our topics again. Continues to remain as a part of the topics.
On that note, gentlemen, thanks so much for joining us this morning and taking us through some of your strategies. We need to take a very quick break. We'll be back in a moment.